With latest jumbo increase in benchmark rate by Bank of Canada while attempting to control runaway inflation, cost of borrowings will increase sharply as a result. Let's explore in this video about recent 1% increase in benchmark rate announced by Bank of Canada, how it is going to affect us all and the assets we own. Should we expect more increases in the future, and at the end my perspective about it. Hi, my name is Sunny and I make content that affect a common man financially. So let's dive into today's topic, jumbo rate hikes. If you are new to this channel, please subscribe to it alongside smashing that like button, as that will help me with the YouTube algorithm, which of course will be highly appreciated. Canada's central bank increased its benchmark rate by 1% point to 2.5%, which makes it the single biggest increase since 1998. This is in the backdrop of 0.75% increase that most economists were expecting. Even the markets were pricing the same, in line with what US Fed did last month. Let's see what Bank of Canada's governor has to say while announcing this steep hike.
An increase of this magnitude in one meeting is very unusual. It reflects very unusual economic circumstances. We are increasing our policy rate quickly to prevent high inflation from becoming entrenched. If it does, it will be more painful for the economy and for Canadians to get inflation back down.
The main reason behind increasing benchmark rate by central bank is to slow down rampant inflation, which has reached an all-time high in the last 40 years. Experts believe Canadian inflation is largely as a result of international factors, but surely there are domestic reasons getting more prominence with time. No doubt, inflation does erode purchasing power of a common man, but in the short term, increasing rates does not help either, as it increases cost of borrowing for both businesses as well as individuals. As a matter of fact, all types of interest rates are linked to this benchmark rate, which has gone up now. Hence, car loans, student loans, lines of credit, mortgages, etc. will all go up. Another side effect of increasing interest rates will be on asset prices like houses or stocks, to just name a few, which are bound to go down, as evident by sell-off on TSX or reducing real estate prices. As a matter of fact, Bank of Canada is going to have another look at economic scenario alongside inflation data in September. Now, I don't see inflation going down, at least in the short term, to their target 2%. Hence, a further increase in benchmark rate will be imminent, which could vary between 0.5% to as high as 1% depending upon the data at that time. There is a clear consensus that times of ultra cheap money are long gone. As a result, benchmark rates are going to go up, at least in the short to medium term, because inflation, which was earlier thought out to be transitory, is well entrenched now. Another contributing factor is how rapidly US Fed is going to increase their benchmark rate in the backdrop of record high inflation, at least in a generation in the US. With higher inflation, asset prices gets inflated, but when governments try to control it by increasing benchmark rates, suddenly cost of borrowing goes up. That changes the whole financial calculus for a buyer. As an example, if you own real estate, now your mortgage cost will go up, but real estate prices are going down. In case you are over leveraged or have taken line of credit against one asset to buy another, you could face some financial challenges. Historically, when interest rates go up very rapidly in a short period of time, we have seen times of recession, which could lead to job losses or times of financial uncertainty. All this will no doubt change our spending habits, which slows the economy even further. Whether we like it or not, cash is always a king in good or even challenging times, because that gives you peace of mind as well as options to buy assets which are much cheaper now. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing and subscribing to it. Thanks for watching and see you in the next one.